Okay, now we've got both going. So, hello.
Hi.
Uh, just to introduce this chat that we're about to have, my name is Michael McDonald, transformational coach for leaders, executives, entrepreneurs, and I'm chatting with Avnish Patel, who's an executive, like past background with like as CFO, COO, various things, and a past client. And the inspiration for this chat is in my world, I get in contact with a lot of startup founders who are in this territory of raising funding. And it seems like it's a challenging thing that they always seem like they could use more help with. And that's something that you've been helping with some people with and you know a bunch about. I mostly help them with the sort of like the inner game of fundraising, and you know a lot more about the actual like outer game of fundraising.
I hope I do.
Yeah. So, uh, to start this off, like tell us a bit more about you, your background, and especially around fundraising and startups.
Sure. So my most important quality is, of course, having been your former and again, future client. Of course, that's the most important. Um, I'm Avnish Patel. I was raised in California, born in London, England, um, and have spent the last 13 or so years as an operator in growth stage Silicon Valley, mostly digital technology companies. Prior to that, I was a private equity investor, and prior to that, I was an investment banker. I even spent a year trying to start a company in the health and wellness space that failed, where I learned a lot, um, and was still a good experience. With respect to early stage, growth stage fundraising, the topic of today's conversation, I have been a part of or led over $200 million in both debt and equity financing for, again, pre-public early stage companies, everything from Series A companies all the way to Series E and F companies, and then been a part of some IPOs. So seeing everything from very early stage financing to later stage financing and understand the mindset of the investors, some of the errors and some of the challenges that founders and CEOs make. And I've been fortunate to be a part of the teams that have been successful in raising that capital, but also as an advisor and a consultant to some of these executives and founders in that fundraising as well.
Yeah, awesome. So, I'm curious about the stages first. Like, there's all these different stages and startups from the I just barely have an idea and I need a little bit of cash to trying to raise a lot more and like angel investors, seed, the alphabet soup. I didn't know, like I don't think I've even heard of like so what are the stages? And also someone who's in the middle of fundraising, considering fundraising, what they should they probably be aiming for? And perhaps, yeah, how might someone tell that they should actually be they're trying to aim for a stage that isn't the stage that they should be aiming for?
Yeah. So a word about the stages starting. You can kind of think of it, I think rather than thinking of it as the alphabet soup and all the before and then going public after, which is one way to look at it, and we can talk about that. I, and this will be the theme of a lot of what we talk about today from me and how I think about fundraising, particularly when I guide founders and executives, is thinking about what traction your product or your service, let's talk about it as a product for now, has in the market. If you don't have a product and you have an idea, right? Then you are likely going to be bootstrapping the company, meaning funding it basically with your own sweat equity, right? You're going to be buying your own dinners. You're going to be, doing it on your own dime and your own time, coming up with something that makes sense. As you start to build something that makes sense, and you might have been able to even build a prototype of some sort, you might be able to go out and get friends and family money. It's kind of early belief capital, right? It's a little bit informal, but you start to get into managing other people's money, or at least having to be a steward of other people's money. And then to be really prescriptive, and it doesn't always go like this, there's angel investors, right? They'll back more the founder at this stage. And this is something you'll hear a lot of, is when you're talking about really early stage companies, oftentimes the investors are really thinking about the character and the credibility of the founders. Now, when when an investor at any stage looks at something they're looking to invest in, they're thinking about the people, they're thinking about the market, and they're thinking about the product. The product is, what problem are you trying to solve? The market is, what space are you trying to play in, or what space are you trying to create? Uber didn't have a space necessarily, right? They were creating a new market. And who are the people that they will be backing? And so once you get kind of into the angel stage, then you can see, again, to be very linear about it, it doesn't always work that you're hitting every one of these. There's pre-seed and seed, where you're starting to get into early institutional capital. That is early stage venture funds, for example, or they could be solopreneur investors that are managing someone else's capital, but often they are investing on behalf of other institutions, pension funds, other investors, so on and so forth. And there, you're really trying to use the capital up until this point to prove that there is a market. You're finding product market fit, which really is the Silicon Valley way of saying, we have a product and we have a market, and the product is resonating in the market as demonstrated by a certain set of metrics or a certain success. Often it's a feeling that you as the founder know about and the market can see, but often you see it in the metrics in the form of retention. Customers are coming in, they want the product, they can't wait to have the product, and customers are retaining in the product. It's actually creating value that customers want to keep paying for. And then once you've been able to establish product market fit and operated the company, grown a little bit, then you get into the alphabet soup, series A, B, and C, where you're really starting to scale. And that's growth capital. And the thing that I will note, to jump around a little bit, is the earlier you are in the fundraising, if we're going back to the bootstrapping, right? Investors are really sometimes buying an idea. They're buying a concept. They're buying a vision. As you get later, I'm gonna keep going this way. I think I should be going this way from your perspective. As you get later on the timeline, what investors are really buying is performance, right? If you get into a Series C and Series D company, they start to really dig into the financials and the metrics. But for, I think, the audience that you oftentimes talk to, which are more early stage folks, they want to see the vision. They want to see the team's credibility. They want to understand the market you're playing in and why your product is going to be better and going to be able to win. And that you have a very clear definition of why or what value you're going to create for that market.
Yeah, I think a lot of the people that I get in contact with, there's a little bit of it feels like a chicken and egg problem. Like it's probably around seed or a series A where they haven't nailed down product market fit yet. They're
Right.
usually still like working towards that, and they want to get a lot of investment in order to get there.
Yeah.
And then there's a lot of the investors really want a lot more product market fit before they invest.
Especially in today's market, right? Where it isn't as frothy as it was in a effectively zero interest rate environment. So I completely agree with you. And if they happen to find someone who is willing to invest, oftentimes the terms will not be attractive. They'll want a really big chunk of the company, right? Or the terms in that are non-pure economics, but with respect to like liquidity preference, liquidation preference, will be really unattractive, right? What happens in the downside scenario? And all of these things, a lot of founders can ignore because they're really focused on, ooh, I got this big investor or I got this valuation. And all of those things need to be taken into account. I'll also note that if one is a proven founder, right, either they have a track record in a particular space or they are a second or third time successful founder, the risk goes down for the investor, right? To use an example, and I know he's not necessarily the most popular person these days, but if Elon Musk was to go out and say, I've got an idea, and the idea is X, he's got no product, he's got nothing. I mean, there will be just billions of dollars of capital flooding his way because he's a proven successful person, regardless of what one thinks of him and his politics.
Mm-hmm.
Whereas another person who may be proven in a completely different sphere tries to start a company, it is likely that the terms for them will be more stringent, or the climb to raise money will be more difficult because they are not proven, and thus the risk in the mind of the investor is higher, even if Elon and this person are going after the same market and the same product.
Mm-hmm. Yeah, which like it's hard to get started.
It is hard to get started, and money is real, and I know that people need money to live their lives and to fund their companies. But the general advice would be try to get as close to product market fit as possible, as quickly as possible. And oftentimes founders will really start to think too broadly about solving too many problems. And then that just elongates the amount of time that they're working on things, which means they're like, I need money. And my advice always is let's define one problem that we can solve on behalf of the customer, the ideal customer profile, the ICP we're going after, and nail that. And then once we nail that, we can start to create a vision around how can this expand? Or maybe that one problem we've just solved is big enough in and of itself.
Yeah, related to that, like what would you say to someone where they've got a really big vision? Um, so if they like narrow down to solve like the one thing, get the one product market fit, but there's such a dissonance between that company that they can get funded and the much larger company that they're hoping to create out of that.
Yeah, I think it's about storytelling and saying we're starting with this one problem
Mhm.
and the vision is this much bigger opportunity. And so you think about examples out there in the market where someone may say, today we're solving, I think this is the story behind Airbnb. It may be just I made it up because it served my purpose, but I think Airbnb started as a company that was solving a problem of people who wanted to go to conventions in New York and San Francisco
I think
and
so,
either
yeah.
couldn't find hotel rooms or couldn't afford the exorbitant prices of those hotel rooms at when Moscone Center was blown up or something at New York City was really popular. And so they enabled couch surfers. They were solving a very small problem for a very specific segment of the market in 2 or 3 specific markets. And that allowed them to prove out that there's a value here. And then they started to expand from there. And I'm sure that Brian Chesky, co-founder of Airbnb, was telling the vision over time while proving that he was actually had a market in this very narrow vertical.
Mm.
And then started to tell the story over time of what this could be. Because a lot of these venture investors, certainly all the good ones, even the mediocre ones, who are investing very early, are thinking about, is this going to be $1 billion plus idea? So it's again a balance of execution on the minor and being able to tell the story around the macro.
Yeah, what about like the stages of funding for people who don't have like it's not $1 billion idea. Like it's like a solid millions or tens or hundreds of millions.
Yeah. So in that instance, and this happens a lot where you've got a founder or a team that says, we could build a really nice cash flow business here that's making tens of millions of dollars of cash and profit. And that's wonderful, right? I don't have to go raise all this money and have the pressure of board meetings and whatnot. Maybe I have to raise a little bit of money. When we go back to from whom you're investing when you're early in your journey, right? If you've been an executive at a number of companies, or you've got family money, or you've got some benefactor, wonderful, right? You can just use that money and fund the company and grow from there and never have to raise a cent of outside capital, too much of it. But if you're like most people and do have to raise some money, what I would say is you need to then consider strongly from whom you raise money, because the expectations of institutional investors will be that they get to return their money in a certain amount of time and that your company will be of a certain size. Particularly when you think about the early stage investors, they are assuming, they know, they have built into their own models that a large percentage of their companies are going to fail. They don't want them to fail, they just know they will. But if one out of every X number can be a home run, they make their whole portfolio, they make everything back and a lot more. And so you don't want to get caught in that. You may say, look, this could be a multi-billion-dollar idea, but I'm really happy with my lifestyle as being able to work 9 to 5 or 9 to 4, whatever it might be. And so then you need to make sure you have alignment with your investors. And that typically means not raising from investors who are taking capital from other outside institutions. You may want to only raise from seed investors, friends and family, or other types of larger groups that are okay taking a cash dividend every year. That could be, for example, a family office. So that's another pool of capital we didn't talk about. But instead of going to institutional capital, you can go to family offices that are basically funds that are investing almost wholly on behalf of wealthy families.
Yeah, and I get the impression that there's a bit of a valley between like that type of funding. It's really like between the seed funding and the more institutional funding, where like there's a lot of there's a lot of company ideas that it sounds like the ideal would be in the middle of that valley where no one wants to invest. It's like too much for one class of investor and it's too little for another class of investor.
Yeah, yeah. So is the question like how to navigate that, or
And part of it is like checking is that an accurate view and any suggestions for what to do about that?
I don't know if there's a valley per se, but I know that it can be tough to navigate, because I think again you have to align on where do you want this company to go, right? What is your vision? And if you are okay with growing more slowly, then maybe you can raise less money. Maybe you can raise from a different set of investors that have a different set of expectations. But if you want to put, fuel on the fire to make this thing really grow faster, then you got to go potentially, not always, raise more money to be able to invest in product engineering and marketing to drive growth over time. So it really comes down to from whom you invest. And the other thing I'd say is with respect to that value, to make sure I'm actually answering your question, it's really a good idea to utilize your existing investors, assuming you have good relationships with them, to introduce you to other investors for your next stage. And that relationship building should begin way before you need capital. Because ultimately you are dealing with humans. And yes, this is capital, and we talk about it in venture capital, but you are still dealing with humans. And we go back to that one of the first things I said, which is these investors whether they be early stage or late stage, are assessing you explicitly or implicitly as a human being. What values do you have? Are you at peace with yourself? Which is some of the work, I think it's very powerful that you do helping these folks. How will you be able to navigate the almost guaranteed ups and downs of a startup, which everyone who may be listening will certainly will understand that. And so I think it's important to develop those relationships very early on.
That's important. Relationship building. Also just a bit more or like continuing the brainstorm. Like what are some of the biggest mistakes that you see people making, like startup founders making when looking for investment?
Try to be organized in this answer because there's a lot of things I could throw out. But if I were to, I'm doing this real time, but if I were to think about fundraising as sort of pre, during, and post, I think I like that framing. We'll see where this takes us.
Like it's chronological.
Yeah, exactly. I'm a very linear thinker. It's pretty much all I got. So I would say that in the pre, going back to what I said before, pre means before you actually start to need the money, right? Not cultivating relationships early is a mistake, right? Not going out and telling investors about who you are, what your value proposition is, what problems you're solving in the market, not keeping those investors up to date. Not all investors want to know, but there's some investors who you reach out to, years before you potentially need their money. Sure, you might have raised earlier from friends and family, but now you're starting to talk to these angel investors or these pre-seed and seed investors and all those things. By the way, there's not like defined things. There are certain groups that'll say we only invest pre-seed or first money in. That's all we do. You've got money, we're out. But most will not. Most are sort of like, yeah, we're not Series C and Series D investors, but we'll play in the seed to like early A's. That's kind of how they'll bracket it. And then there's the really big guys out there that are like, yeah, we only write checks that are $100 million or more, and that lends itself to being later. But across the board, it's really important that investors cultivate those relationships early on. So mistake is not cultivating those relationships before you actually need the money. During the fundraise, I would say, and again, this all presumes that the company has a product that works pretty well. Let's just simplify around that.
Mm-hmm.
During the stage, I think it's lacking a crisp narrative about why now, why there is so much demand for this product now, why them, the company and the team, and then why this particular idea. So it goes back to that framing of why us as a team, the team, why this market, and why this product in this market, right? Being able to tell that really crisply. And then in addition to selling that vision, being able to corroborate that vision and the specifics with data and metrics or customer success stories. And again, I'll go back to the point I made earlier, which is the later stage you are in seeking funding, meaning going along that alphabet soup or from bootstrap to seed, the more evidence you need to demonstrate. If you're in your very super early stage, well, there's just probably not a lot of data you have. Maybe you have one customer, maybe you have two, maybe you have a couple of customer testimonials. I don't know, right? Maybe you've got experience from another company and you're going to tweak that and be able to create some massive market. But the evidence and the burden of proof goes up the later you get. So this kind of gets into like, being able to tell that story, but tell it, the vision and the story crisply with corroborating evidence. And then I guess I'll say after you get a term sheet, which of course is an expression of interest and an interest in investing in the company and outlines the broad terms, is only focusing on valuation, right? And if you're fortunate enough to get multiple term sheets, it's really important that investors don't just go and say, I'm going to take that term sheet as the lead because that's got the biggest number around it. Because there's not always guarantee that A, that's going to get funded. B, you don't want to necessarily have such a high valuation that you can't justify it in your next round. You have to then have a down round, which is bad for everyone. We could do a whole session on down rounds. And not thinking about the other terms in your term sheet, such as liquidation preferences and all the other terms that are out there that can get really nasty, potentially, particularly in downside scenarios, which do happen, either because the product's not working, because the management team's no good, the market collapses, tariffs, whatever it might be. So I think that's what I would say are the big three challenges. And then the fourth one, I guess, in that third bucket is not keeping your investors in the loop, forgetting about them after you've got their money.
Yeah, there's definitely some things you could zoom in there, but I'll sort of like keep this broad.
Yeah.
From the investor's perspective,
Mhm.
like how do investors see this? What's their world like compared to the startup founders world where they're just trying to like get funding?
Yeah. I've never been an early stage investor, but I've raised money from them, have family members who are early stage investors. And so I'm less capable of opining on this, but I will take a stab at it nonetheless. Um, I think if you just look at an investor, what they have to do, it's, broadly speaking, these investment firms, they have to manage their customers who are really kind of two types, right? There's those that are giving them money, the limited partners, right? It could be an endowment, it could be a pension fund, it could be a family office, it could be other executives, could be, non-profits maybe. Well, that might be weird. And then the group of executives at their portfolios. And they need to ensure that they're differentiated for the limited partners, that they're differentiated in their value proposition to the portfolio companies and adding value there. And that they're continually bringing in new capital and deploying that capital at a clip that makes sense so that they can go raise their new fund. Because part of the way they make money is through deployment of money. And this is one of the things that is not necessarily well known, which is like they make money on the capital raise, even if they haven't returned a dollar to their investors. Now, they won't necessarily raise another fund, most likely, if they don't do a good job of generating good returns, but they do make money by simply having that pool of capital and deploying that capital.
Mm.
So I think it's how to manage both sides of their world, the LPs and the portfolio, how to continually grab new investors and how to find new investments to make. So I think that's the world that they occupy. And then getting smart on various end markets. And I think this is an opportune time to say, and it goes kind of back to the errors you asked about before. One of the big mistakes that executives at companies can make when they're going out and raising money, and I've certainly made this mistake, is saying we want to raise from this firm because they focus on fintech, crypto, AI, health tech, whatever it might be, beverages. And that's good, but that's not enough. You need to know who the right partner at the fund is. Sometimes it's clear because they're a partnership of one investor. Or sometimes it's very clear because these two people are all in on everything. But there are certain larger funds when you get a dozen individuals. And sometimes it isn't the partner. Sometimes it's the one person below them, the principal, who is the specialist in that end market. You want to be talking to them. They need to be able to understand your story, and they need to ultimately be able to take your idea in your prospective investment to committee, and you bring them on your side. So now you guys are together trying to go get funded by that institution. I forgot what your original question was. I'm not sure I answered it.
Oh, well, I've got a follow-up question there. Like, how do you, is it, yeah, sort of like, what are good strategies for how to meet with the people that you really want to meet with? Like, I've seen people where they're like, I could imagine just like, it's like, I want to talk to this guy. Like, I just want to get a meeting with this guy. I've also seen the approach of meeting with everyone and gradually working your way up. I had like one past client who like she had the A's, the B's, and the C's,
Yeah,
like this increasing status.
yeah, yeah. I think that's the A's, the B's, and the C's are a good way to do it. You can very quickly get pretty exhausted from fundraising. I mean, this is the really terrible thing about fundraising. When you fundraise, you are creating effectively zero value for your shareholders, right? You could make the argument, well, I've increased the value of the company because our post-money valuation has gone up, but you've actually created no real business value, right? So in a perfect world, you would fundraise as quickly as possible and then go back to running the company so that you can actually create solutions for customers, thereby creating value for investors. So I would say that going out and talking to everyone is not a great strategy. And being really targeted and specific about with whom you want to talk because there's alignment around their areas of focus, their mindset. There may be some other qualities that resonate with you and them. There may be a common scholastic background, for example. Again, we're talking about appealing to humans, right? So anything that you can find to get purchase around with them to actually listen to you for a minute is worthwhile. So the first thing I'd say is network. Use your network of your current investors to network into your next round of investors because they're going to be able to, they all talk anyways. And they'll be able to vouch for you and say, hey, yeah, this guy is great. He's a good operator. He's navigated some stuff. He's been able to, he's been great for us. That's number one. Number two, if you need to go a little bit broader, really demonstrate your expertise in that field, whether that be through LinkedIn posts, although I encourage people not to like overthink it on LinkedIn and spend all their time there. But it can be a way to start to cultivate some expertise and then get the ear of the related investors in that space as well.
There's that, yeah, because there's that period. I often hear that basically becomes a full-time job doing the fundraising.
It is.
It's like they're supposed to be being a CEO and they're spending almost all their time trying to get the money in order for the company so they can be the CEO.
That's right. And that brings us back to one of the early questions is, how much money does one want to raise when what kind of company do they want to build? Are they comfortable building a company that does $10 million or, $5 million in recurring revenue, ARR, and run that like that forever? And while that probably won't get venture funding, that may be enough for some people, potentially for most people, especially if you don't have too many expenses to then live a nice lifestyle. So
How long? What are some like time ranges that are actually realistic compared to what people hope that it will take?
I think going back to going to the idea of creating relationships, I think that sorry, let me answer this way. I think it's important that you think about this in terms of having like 18 months of cash on hand. That's kind of the like rule of thumb that I like to have, and I'm a bit more conservative when it comes to cash. Others may be willing to bring that down. So I would start earlier than that, and 3 to 6 months in advance of that, and starting to have conversations, letting people know that you're starting to go out and to tell that story and assume the process will take. I have never yet been able to do an early stage financing in under 5 months and more like 9 months. So from like first conversation to funding, the first conversation with any investor, not the specific investor who ends up leading the round, but the first conversations, the last conversation, and the funding in the bank has been about 9 months. That may be because while I have raised a lot of money, the end is still relatively low, right? We're not talking about dozens of attempts at bat. We're talking about 5.
Mm-hmm.
And so I will qualify that that is my experience. No doubt there are going to be people who listen to this and say, well, it's only taken me 2.
Mm-hmm.
And that, of course, may be because they're better at targeting, they got lucky, or they have product market fit and the company's metrics and performance is up and to the right.
Another question. And yeah, there's a spectrum between starting to have these conversations, starting to talk with investors, and from all the things that they point out are wrong, they go back, they figure that out, they work on the product, they come back, and there's like this iterative approach versus the approach of they're going to not talk to any investors until they have the perfect pitch, and the goal is to come into the meeting and win the business in the meeting. Where within that spectrum is actually realistic?
So is the question, should a founder wait to raise until they're like have a perfect pitch and a perfect product and everything's perfect?
Yeah.
Yeah. I think perfection can oftentimes be endemic with like the startup founder type who are like super type A and have a lot of pride, and that's wonderful. But I think that you can do yourself a lot of disservice. There's the practical reality that you probably don't have enough time and financial runway to get it quote perfect because you're going to run out of money and then you've got nothing, right? Then there's no perfection because you've got nothing. You have no company, you have no product. So that's one sort of simple way to answer this. The other is not to get too philosophical, but like, what is real perfection? And then the third, I think, most practical answer is that understand that particularly early, investors are not looking for perfection. They're not looking for everything to be totally fleshed out. They've seen this a million times. They know that your UI is screwed up. They know that the UX is messed up. They know that you haven't built out these other 2 features that you think are going to be incredible, but is still a hypothesis and your vision. They know all that. And that's important to kind of weave into the story. But what's critical right now, first and foremost, is to demonstrate that your product works in a narrow band for a certain segment of people to convincingly solve a narrow set of problems for that individual that is real pain for that group of individuals.
Awesome. That's powerful.
And then to iterate from there.
Yeah. So one last question. So
yeah.
What's one last piece of advice you wish every startup founder knew before they started fundraising?
I think it's, Michael, honestly, I'll give you 2 here. One is understand that these investors can be incredibly powerful guides, partners, helpers, advisors along the way, or they can become total nightmares. So it's really important that you also do your diligence on them and talk to other founders on how those VCs or investors have been, especially if you're giving them a board seat in downturns or when you lose a customer or you miss a quarter or whatever it might be. I have seen VCs be wonderful when they're trying to track you as an investment and then be a total nightmare in the boardroom. I've also seen venture capitalists who are incredible in their support, in their partnership, being available to help you as a human, but also from a business perspective. So be very, very careful of that. The other is, and again, I've never been a startup founder. That's not true. I tried starting this business and it failed, but never a successful startup founder. And what I'd say is that they all know how tough it can be. So fundraising only exacerbates all that because you still have all the other responsibilities while trying to get money and often getting a lot of no's along the way, which can feel really terrible. So a lot of the work that you do, I think, is really important for these individuals to feel that what necessarily the feedback they're immediately getting isn't a referendum on them. And that, so know thyself, know the market, know the product, but know thyself and make sure that there's an equanimity when you go into the fundraising process because it's already hard. And if you can ride that wave a little bit, I think one will come out more successful in the end.
Awesome. Yeah, thank you so much.
Thanks for the time. I appreciate it. I enjoyed it.
Yeah, if anyone sees this and wants to be able to reach you, I'll probably will include contact info in description. But is there anything you'd like to share right now?
No, I think that's it. You can help them find me if I can be helpful. But I really appreciate it. And Michael, thank you for the work you do.
You're welcome. Thank you.